The call of the question is what total amount from the above should be included in the gross income in year 1 tax return. A married taxpayer, age 49, received the following in the current year. So they're talking about the current year itself. Interest earned on federal treasury bills. This will not be included, guys. Interest earned, they're saying what is included. This is not exempt. This is not exempt. That means included. You're going to take this 1,000. Okay, so federal income will be taxed. So this is taxable. This is exempt. Interest on a municipal bond is not taxable, but it is exempt. So it will not be taxed. Interest on state income tax, again, not taxable. It is exempt. Interest on Series E saving bonds, which is used to help pay for room and board. Had it been for tuition fees and books, it will be exempt. But since it is room and board, it will not be taxable. This is not state income. This is not state bond, guys. This is refund of a state income tax, and on that refund I have earned an interest. So I know that refund is taxable. The refund is taxable. Please understand, this is not state bonds. I read it mistakenly. This is a refund that I was supposed to get from my state taxes. Remember, the refund may be tax-free. I don't know. We're going to talk about it as we study further. But the interest on these refunds are always taxable. So the amount that will be taxed is $3,100. $3,100. So federal bills, always taxable. State, municipal, not taxable. Refund may not be taxable, but interest on refund will always be taxable. Series E, if paid for qualified tuition, books, and fees, not allowed if paid for room and board and travel. Is this clear? Any questions? Okay. I think this question, you can give me the answer on your own. Will you try giving the answer to this question? Everybody? What amount, if any, should Stone report as taxable interest income on his current year tax return? So what amount is taxable? Not tax-free, guys. Read the question really well. In the current year, you receive the following interest payments. Interest of $400 refund of federal income tax for previous year. Taxable, non-taxable. What do you say? Taxable, non-taxable. Interest on refund of federal income tax. See? Easy. So this is taxable. So 400 is taxable. Interest of 300 on award for personal injuries sustained in an automobile accident in a previous year. So the award may be tax-free. I'm not too sure. But I know interest for delayed or deferred payment, this interest would be taxable. Municipal bonds, municipal bond interest, taxable, tax exempt. Municipal bond interest, taxable or tax exempt. Please write your answers in the chat panel. So municipal bond interest is not taxable. It's exempt. Interest of 1,000 on United States. So this is federal savings bond. See, the idea that they've given you a series HH is just to confuse you because it's series EE bonds. This is a federal government savings bond. This will always be taxable. So total $1,700 would be included as a part of the tax net. We have a very good question on Series EE bonds, especially if I let you know that the entire amount was not used for qualified education expenses. Then what do? What portion of the interest gets taxable in your hands? The call of the question is how much interest income can the taxpayer exclude? So how much will not be reported to tax? That's the call of the question. Be very clear when you're reading the call of the questions, guys, okay? So in February of the current year, Paul and Jean, who are a married couple, cashed. That means they closed their Series EE savings bond that they bought in November 2013. So long time back, they had bought it and now they've encashed it. They received proceeds of 7 months. So when there is a payout from Series EE bonds, how much is the payout? 7, out of which I had invested 5,000. The interest on it was 2. So I know my principal cannot be taxed in my hands. I'm only talking about the interest. In the current year, they helped pay their daughter's college tuition. The qualified education expenses they paid in the current year totaled $4,000. So the amount is not the full figure. They are not claiming an education credit and they do not have an education IRA. How much of this interest income will be taxed this year? So you will not assume this 4,000 to come first from interest and then from principal, first for principal and then for interest. The answer is simple, pro-rate. So out of this 4,000, how much is supposed to come from interest? It is 2,132. The amount of interest is tax-free. The balance is taxable. Call of the question is how much is tax-free? So this amount would be tax-free. The balance would be taxable. So now if you go to the question, you remember, see, if qualified expenses, in my example, $4,000, then the total amount of principal and interest redeemed, in my example, 2, then the interest, in my example, 2, is multiplied by the exclusion rate. What is exclusion rate? Proportionate figure to determine the amount which is excludable. So in my example, I took out the exclusion rate. Out of 7, what is the excluded amount? Then out of 4,000, how much is the excluded amount? And I use this to calculate the amount that will be exempt from my series bonds this year. Now, this is a very easy question, and I think by now you would have developed a sense for it. Give me the answer for this. See, California is a state. New York is a state. Seattle is a state, and this is, maybe a district or a municipal bond. AT&T is a corporate. Now give me the answer. AT&T is a corporate. So how much of it can they exclude from their tax return? All of this are exempt because it's a state or a local government bond. See, now when you do GAAP in the US, you will see that there's a government accounting concept. So the government will not just raise you a government bond. They'll raise you a government bond for a purpose. So New York has issued a bond for sanitation fund. They want to spend money on strengthening the sanitation network. Seattle bond has issued a bond for the improvement of the schools in the district. California has given you a general revenue bond for a specific purpose. So these are all state government bonds. AT&T is a corporate. Hence, so this is an applied question that helps you understand whether you've understood the basic concepts or not.